The Federal Reserve is meeting today as we speak, and at 11 o'clock they probably will announce a 25 basis point increase in the federal funds rate to a new range of 175 to 2.0. The interesting thing is what they're going to say about the outlook going forward, and the other thing is whether they're going to have a press conference after every meeting as opposed to having a press conference after every other meeting, because the markets are basically assuming that they won't change interest rates unless they have a press conference to explain what they're going to do. So if they raise now, no one is thinking they will raise at the July meeting, and you wait till September, and then they won't do anything in October, you wait till December. But if they have a press conference after every meeting, all of a sudden those meetings, even though they say they're live, really will be live, will be live meetings for real. But our guess is, and 99.75% of all the forecasters are saying they're going to raise rates today. And our theme is interest rates are moving to the center stage. Interest rates are in the process of normalizing, and we're going to look for higher long rates as well as higher short rates. Okay, our themes is the markets are signaling, in our view, higher inflation, higher interest rates, and we're shifting, at least temporarily, from a slow growth economy and a low inflation economy to something faster. We think we're going to have 3% growth this year. Unemployment is going to drop to 3.5% by early next year. And if you want to think about our forecast in a very, very simple-minded yet accurate way, on a fourth quarter to fourth quarter basis, think it was a 3-2-1 economy, 3% this year, 2% in 19, and 1% in 2020. So when you get down to 1%, you could talk about a recession risk in 2020. Growth is going to be powered by, on the business side, by business investment. That's going to be the main driver of growth. And housing, even though it's getting better, is not going to be all that robust. And we have a slowdown in 19 and 20. So that's sort of simple-minded version of the forecast. And basically, our forecast was above consensus for the past 3 quarters. The forecast you're going to see today, except for interest rates and inflation, we're a little bit above consensus. For real growth, unemployment, employment, we're right on consensus right now. The consensus is basically over the past 6 to 9 months has moved up to us. So the forecast you're seeing here today, if you look at the Blue Chip Indicator Survey, where there's 55 economics groups in the survey, we're part of that survey. We're right on top of the consensus for 2018 and right on top of it for 2019. So our view is we will get 4 rate increases this year. So the Fed goes in June, goes today, and then goes again in September and goes again in December. We have another 3 or 4 in 2019 and maybe 1 or 2 in 2020. And our Fed funds rate, we end the period around 3.25% plus or minus. That's also consensus. We just get there a little faster than consensus. So this is not anywhere near out of the mainstream. Where we're high is we have long rates going to 4%, the 10-year Treasury going to 4%, and I'll explain why we're above consensus on the long rate. And you see it trending down at the end of the forecast period. That's because we have the bond market sensing the slowdown in the economy. So that's the reason for the turn down. Okay. Now, one of the risks to our forecast is there's a 2002 movie, The Italian Job, and a euro crisis would change the forecast on rates. And when the market got upset about the election in Italy, there's a very strange government in Italy. Italy, you have a far left, far right coalition government in Italy, and the far left and the far right, when they were running, say they hate the euro, they want to leave the euro, but now they're in power, they want to stick with the euro. But imagine a coalition government, a cabinet with half Donald Trump supporters and half Bernie Sanders supporters. That's the Italian government right now. So how long that lasts, now they have a history of governments falling apart there all the time anyway, so this is not exactly a stable coalition. They agree maybe on what they're against, but there's no agreement as to what they are for. And this is what happened here. What got the market spooked was this big shoot up in interest rates. So imagine here you have our 10-year Treasury goes from 1.8 to 3% in a week That would sort of shake up the troops a little bit, and you had real carnage. You had real carnage in the bond market. Now they're around 2.7. But what's really strange about it, the United States is 2.9, 2.95, our 10-year. The 10-year Italian bond is 2.75 today. And who wants to, would you rather lend Italy at 2.75, or would you rather lend to the U.S. at 2.95? That's because German rates are very low, and that's what's keeping down the Italian rates. But Italian rates were 1.8 before this thing erupted, and that's what caused got the market spooked. But now it looks like we're probably not going to have a euro crisis, at least right away. Okay, now the domestic backdrop for higher rates is we have higher inflation. The year-over-year inflation in the consumer price index right now, anybody care to guess what year-over-year inflation is on the headline CPI? 2.8. Somebody read the news yesterday. It's very good, very good. 2.8. So us forecasting over 2% into threes that's already in the numbers, and core, which is without food and energy, is 2.2. Wholesale price index came out today, was up a lot, but largely due to gasoline. Core was okay on the producer price index. But we have basically inflation being in the 2.5 to 3 range, and that's sort of above where the market is, and the market's more in the 2 to 2.25 range, 2 to 2.5 range. So we're above consensus on inflation. Now, part of the reason why we're there is we have much higher wage increases forecast. Now, we've been forecasting an ignition in wage inflation for a long time, and for a long time we've been very wrong. But let me give you a little vignette as to what's going on. There's an article today in today's Wall Street Journal about new law associates at the top Wall Street law firms, the big law firms, coming out of Harvard, Berkeley, here, UCLA, Stanford Law School. They're starting at $180,000 a year, up from, I think, $160,000. But if you go to Hobbs, New Mexico, or if you go to Midland, Odessa, Texas, and all you have in your possession, you could be a grade school dropout, and all you have in your possession is something called a CDL. And the CDL stands for Commercial Driver's License. And with that little CDL in your pocket, you too will make $180,000 a year. So when labor markets get tight, that's what happens. So our argument is with unemployment now below 4%, and the Fed has a whole series of surveys where unemployment in cities getting down around 3.5%, 3.7%, they begin to see significant wage increases. We think we're finally going to see that, but we've been wrong about this for over a year on that. So that's a sense, that's part of our inflation story is higher wages. And you see that, the local economy in the Permian Basin, which will be the third biggest oil producing, if it were a country, it would be the third biggest oil producing region in the world. It would be, Russia, Saudi Arabia, Russia, Permian Basin, and then the rest of the U.S. Because there'll be 5 million barrels a day coming out of there. Okay. Now, the other thing going on a technical basis is we're in a period of quantitative tightening. The Federal Reserve, instead of buying bonds, as they did in here, there, is now beginning to sell bonds. And that's going to continue. The balance sheet got up to about $4.5 trillion. Some people have it going to $3.5 trillion. Some people have it going to $2.8 trillion. But every day, Federal Reserve, every single day, tick, 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 is selling bonds instead of buying bonds. So there's going to be natural technical pressure on the bond market, more supply where there used to be demand. And then the federal deficit is going to explode, and we're going from $600 billion in round numbers to over $1 trillion in 2020, coming from the tax cuts and the spending increases. So we're in a position right now where we're going to have $400 billion more in federal deficit bond supply coming on, and the Federal Reserve is probably going to be selling $200 to $300 billion a year. So you may have $700 billion of supply that we didn't have before, and I think that's change in supply-demand balance dynamics will affect the long Treasury, and that's why we're getting them to 4%. That's the argument. The argument against that is if German rates stay really, really low, and the European Central Bank, which is also meeting this week, doesn't do anything, the spread could be too wide, we may not get there. But that's our argument purely on domestic supply and demand. you get there. And you just think about it. If you close your eyes and say we are at full employment, and this is the first time we're running a deficit of 5% in peacetime with full employment. We have deficit of 5% of GDP, full employment, peacetime. Never had that before. So if you have high deficit, full employment, rising inflation, Federal Reserve selling bonds, you would think interest rates would go up in that kind of environment, and that's our argument. Now, here's our 3-2-1 economy. We have 3.4% for the current quarter. We did this a few weeks ago. When you put it, we had to do it again, we'd be above 4% for the current quarter. Most of the people who track GDP on a quarterly basis, looking at as the data comes out, the number's over 4%. So the current quarter could come in a little bit above what we have, but my guess is we'll give it back in the third quarter, so we'll average the 3 for the 2 quarters. And you see growth gradually fades down from, call it 3.5, down to 1 on a quarterly basis. That's sort of our 3-2-1 forecast. And payroll growth slows because we're running out of people. And I'll give you an example. We were 200,000 people last 12 months. We're slowing to about, for the next 12 months, 130,000. 12 months after that, we're going to be about 80,000. Then we're going to be down about 60,000. So the thing is, if you think in terms of real estate and employment growth, if employment growth drives apartment demand, if employment growth drives office demand, we're going to be going from a 200,000 job economy creating down to a 60,000 job economy over the next 2-3 years, and that's going to slow demand. So I don't think the markets are ready for that, and the reason is we're running out of labor. All right, that's the unemployment rate, bottoming at 3.5, and then as the economy slows, we have a gradual uptick to about 3.8%. Most people don't have that, but our sense is if we're going to get down to 1%, economy, we're going to have a small rise in the unemployment rate. Okay. What's going to drive the economy is going to be business investment. This is equipment, which is going to be growing at around 7%. And that's a product of the tax bill, 100% expensing, lower corporate taxes, bringing the cash home from international tax havens. We'll get about 7% growth in equipment, gradually tapering off, because what we're doing with 100% expensing is we're just pulling forward capital spending that would have taken place next year. We're doing it this year because firms could write off the full amount instead of depreciating it over 5 years or 7 years. And same thing holds true for business structures, and we have a big boom in business structures. But you have to remember, in business structures, one of the biggest components is oil and gas drilling, and that's that big surge there in what we have there in the first quarter, and then it begins to slow down a little bit. But we have business structures doing well until the end, and the end is we have commercial construction tapering off at the end. That's why we get a negative on that by the end of 2020. Now, housing, and I'm going to give a talk on housing a little bit later. Yeah, it looks great. We've gone from 600,000 to maybe 1.4 million. But the very, very long-term average for housing starts, 1959 to 2017, the average is 1,435,000 starts a year. We're not going to get to that this cycle. We're not going to get back to average. And normally in a big cycle, normally we'll get to 2 million or what have you. But we're not even going to get to 1.6 million or 1.7 million. And I think, so housing will do better, modestly better, but in the face of higher rates, we have housing rolling over in 2019. A little bit less constructions. Even though it looks great from 2008, I'll show you a chart later, which will go back to 1959, and you'll see what happens when you have a booming economy, you normally get 2 million starts a year, and we're not even going to be close this time. We're not even going to get back to average. Now we have here, our friend is when in the beginning is sleepwalking into a trade war. Now for all of you aficionados of Star Wars, you have to understand the original thing that started the intergalactic war was a dispute between the Trading Federation in Star Wars. So we're basically playing with an intergalactic war, and we're playing with the cosmic forces of the universe. And we have here a shootout. And this is the shootout. This is a cartoon from the Financial Times. And we have Donald Trump aiming at China, but he ends up shooting Canada, Mexico, and the EU. And this is how trade wars, we're sleepwalking into these kind of trade wars. So if we have a big risk in the economy, the big risk is this develops into a trade war. And we're going to get this, no matter what, we're going to get a rising trade deficit. Because the thing is we're consuming more than we produce. We don't have enough savings in the country, so we have to import capital. And the flip side of importing capital is we have a trade deficit. Then that's how the GDP accounting works. So we're going to go from 600 billion to 800 billion on the trade deficit. So all the talk about bringing the country into balance, no matter what the president does in the near term, assuming the economy is growing at roughly our forecast, the 3-2-1 forecast, the trade deficit has to go up, independent of any trade policy. And if we don't import from China, we'll import from Thailand, or we'll import from India, or we'll import from someplace else. Because a booming economy is going to suck in imports. It's going to suck in imports because we don't have enough savings to fund our own consumption. And here is the trade picture. And it's complicated, but Trump is all upset with Prime Minister Trudeau of Canada. This is merchandise only. The United States right now imports 300 billion of goods 2017 from Canada. Okay, we export 282 billion. That's on goods. If we count services, we have a slight surplus with Canada. So I don't know why he's going to war, a trade war with Canada, where we have a $2 or $3 billion all-in balance, a favorable balance with Canada, about $3 billion, but we're roughly in balance. With China on merchandise, we import 500 billion, and we export to China 130 billion. That's the real big difference. And that's with Germany, it's 53. We import 118. So that's where you see the imbalances. So there's a chart in your handout where all the numbers are. You don't have to memorize this. But the big imbalance is U.S. and China by 370 billion. With Canada, we're essentially even. With Mexico, it's 314 versus 243 on goods. But the thing is with NAFTA, and with what happened at the G7 meeting, is if we undo NAFTA, the whole supply chain breaks down. Because an automobile will cross the border 6 to 20 times, depending on the car and who's making it. Parts will go back and forth between U.S., Canada, and Mexico to make it on a tariff duty-free basis. Once you stop putting tariffs in front, this whole supply chain breaks down. And supply chain breaks down, the economy will crack open. And all of a sudden, you'll have all kinds of friction in the economy, and workers will get laid off. In the case of the steel tariff, the steel and aluminum tariffs, you save maybe 40,000 jobs in steel and aluminum manufacturing, but you lose 500,000 jobs in all the steel-using industries as a result of higher prices of steel and aluminum. And what I tell my sort of friend Larry Kudlow, who I've known for years, the president's economic advisor, he used to be this really anti-tax guy. All taxes are bad, and I always tell him, Larry, a tariff is a tax. A tariff is a tax. Repeat after me. A tariff is a tax on it. And what tariffs do and trade barriers do is they raise prices and reduces output, and it's an tax on American consumers. So how that could be expansionary is beyond me. But that's sort of the trade policy. So if we have one big risk in this thing is we sort of sleepwalk step by step by step, and all of a sudden we could find ourselves in a recession, not in 2020, late 2020, 2021. We could have a real risk in 2019, depending on how all this sorts out. But for whatever reason, the stock market is completely oblivious to this. So we'll see. The stock market also may be sleepwalking. So to conclude is the era of very low rates is over. We have higher inflation and rising budget deficits. The economy, if we don't have this big trade war, is 3-2-1 growth path. Strength coming on the business side. Housing is better, but not great. And the major risk is we could be on the precipice of a trade war, or we could have a new euro area crisis. So the risks are really from trade policies, the risks to the economy. Otherwise, the economy this year is good, next year okay, and 2020 we're going to have risks because we have these huge imbalances building. We're getting the good part of the tax policy early, and we're going to get the bad part of it later with a rising deficit and higher rates. So thank you very much.